Hey, what's up, guys? This is Andrew from Dividend Growth Masters. Now, one thing that I've seen over the news a lot, with a lot of focus on, especially on CNBC and a lot of financial media sites, is the inverted yield curve. So I wanted to talk about that and what the impact is really for dividend investors and what you should be doing in terms of positioning your portfolio if there is a recession on the horizon. So basically, an inverted yield curve is when interest rates on short-term bonds are higher than longer-term bonds. So earlier this week, or it might have been last week, the 2-year bond in the U.S. was trading higher than the 10-year bond, and that's not normal. Typically, longer duration securities should have higher interest rates, higher rates of return to compensate you for the increased risk over that time period. And the inverted yield curve has historically been a very strong indicator of a recession in the near term. I think there was a study that was done, I forgot who it was, might have been Bank of America or Goldman Sachs, one of those big investment firms. But anyways, they said that every recession has been preceded by an inverted yield curve. So the question for a lot of dividend investors is, if there's a recession on the horizon, what should you do to position your portfolio? Well, first of all, if there is a recession on the horizon, your portfolio will definitely take a hit. I would position yourself psychologically to at least assume a 30% or 40% hit in your portfolio. So one thing that you really want to do, well, there's two things, and they're kind of related. So one thing is you need to have a little cash on hand. Now, I'm not saying, sell your entire portfolio and go 50% cash, but I've been, in my own portfolio, selectively reducing exposures to certain stocks and industries, getting a little more cash on hand so I can invest and deploy that capital when there's more volatility in the market. Volatility is opportunity. And the second thing that you want to do is have a list of dividend stocks that you want to buy at more attractive valuations. In my past videos, I talked a lot about Service Corporation International and National Research Corporation. Those are both, in my opinion, great dividend stocks that I would love to own more of at more attractive valuations. So if there is a recession on the horizon, I would definitely be buyers of those stocks. So I would get a list of 10 to 15, maybe even 20 stocks where you would want to own it if the valuation is way more attractive, and start paying attention to those stocks. Get a watch list set up for those stocks. You can get them set up at your brokerage account or through Seeking Alpha. A lot of good online resources to get your watch list set up and get alerts as well. You definitely want to get price alerts and price movement alerts for those stocks. Now, in terms of a recession, here's the thing with dividend stocks. Typically, they should be hurt less, assuming you've invested in well-run dividend stocks. This is because these companies are, for the large part, very strong financially. They're very financially stable. They have a good customer base. So your portfolio will get hit, but it shouldn't be as heavy as the overall market. Now, one thing that I've done in my portfolio is I've reduced exposure to very cyclical stocks. And that's important because cyclical stocks often get hit the hardest in a recession. So you're talking about things like industrials, anything related to automotive, anything related to credit. Those are very cyclical stocks, and they go in very big boom and bust cycles. So I reduced exposure to a lot of those companies and industries. And one other thing that you want to do is you want to check the dividend sustainability of across all of your holdings. So whether you have 20 or 30 or 40 stocks in your dividend portfolio, I would definitely check them. A dividend cut is pretty, it can be common during recession, especially if you look back in 2008, 2009. And obviously, a dividend cut to a dividend stock is no good for your portfolio because the stock will absolutely crater. So you want to check for the dividend payout ratio and see if it could take a 20 or 30% decline in earnings if they would still be able to pay out that level of dividends that they are right now. So anyways, that's just a quick guide or tutorial on what to do, what to expect now that we've seen the inverted yield curve and what that means in terms of recession for dividend investing. If you have any questions, let me know. You can email me, check out my website, dividendgrowthmasters.com, or leave a comment below. And if you want to learn more about dividend investing, be sure to check out my site, dividendgrowthmasters.com, and sign up for the online course. All right, I'll see you guys next time. Good luck investing.